Last 20 years, Nifty giving 12% per annum return. If I start with 100, it will become 10x. But if I start with momentum, it would have been close to 55x.
Is it a good strategy to allocate 100% to momentum?
With momentum, it's important to take care of the risk rather than taking care of the return.
As we tell all of our investors, it depends on two things. One is the investor's risk appetite, and second thing is the market timing.
What are the behavioral aspects that actually fuel this kind of alpha?
If you want that exponential return, like if you want to make north of say 20-25% per annum, entry point matters a lot. At Qode, we don't use the vanilla method of momentum because that we think is lackluster or it's not good enough in its original form.
Let's say if I compare Nifty to 30 years back, how many constituents were there in Nifty 30 years back that are still there today?
So if momentum works brilliantly on stocks, does it also work that well across different asset classes? Good morning, everyone. Welcome to our new podcast. We are going to be discussing power and limits of momentum, and we have with us Gaurav and Rishabh like always. So really excited to discuss our favorite factor, momentum.
Thanks, Pradeep.
I guess one of our favorite factors.
Yeah, sure. So the first question, let's me begin with, is that momentum is a very strong factor, and it seemed to have worked across cycles and over the years in different countries. Can you first explain our viewers like what exactly it is?
So, I can take this one. Ideally, when you're looking at momentum, the simplest and the easiest way to think about this from layman terms is that you want to buy anything that's running. And running in terms of price, earnings, etc. Momentum could be used as a factor on different metrics. So, when you say we can use momentum on earnings, it can be used on price, it can be used on multiple different factors. But ideally, the thought process is that, you want to buy something that's moving up. The most common way of looking at momentum, specifically in India or across the world, is also just based on price. That things that are at their 52-week highs or that are making new highs, you want to make that a part of your portfolio, and things that are falling short of the new highs or are at lows, you don't want to consider that in your portfolio. So that in a short summary is momentum investing. There are multiple variations of momentum investing, and obviously at Qode we don't use the vanilla method of momentum because that we think is lackluster or it's not good enough in its original form. So that that is momentum investing for you.
Yeah. Firstly, let's try to understand the results of momentum before we discuss how it's formed. So let's say over the last 20 years, 21 years, let's say since 2005, Nifty has given close to 12% return year on year. Now there's a factor which has given double the return as compared to Nifty, almost 22%. Now that factor is momentum. Now, if I just look at it in terms of the end portfolio value, double the return annually does not mean double the portfolio. Let's say if I was to look at the last 20 years, Nifty, giving 12% per annum return, it would give me a portfolio. If I start with 100, it will become 10x. But if I start with momentum today would have been close to 55x. So there's a difference of 5.5 times in your portfolio value if I was just plainly simply holding momentum. So that's the result of momentum. Obviously, we'll also end up discussing other things that comes along with momentum, but this is the upside that we're looking at.
Right, that's really fascinating, and that's why that factor has become so popular in India as well over the last few years. So when we try to understand the outperformance of momentum, what are the behavioral aspects that actually fuel this kind of alpha? What is the reason that it works? What are the behavioral biases? If you could just talk about that. Is it just herding of people in a stock, or what causes that kind of return?
So we sort of, that's a valid question to ask, and I think if you're running a momentum backtest, you need to understand why it's doing well. So one of the things that we do is we try to break up the return. A part of the, the high return that we are seeing in momentum is because of the earnings growth in the underlying businesses, but a part of the return is also attributed to the price to earnings expansion, wherein people are expecting this kind of earnings growth to continue for years to come. So ideally, if you are looking at any backtest, whether it's momentum or any other factor, you want to be able to predict earnings growth. And we've seen that, say, momentum, like Gaurav mentioned is showing a 22% CAGR over, say a 15-20 year period, the earnings growth will also be significant. It will probably be 75% of that CAGR should be the earnings growth, and then the rest will be the price to earnings expansion. Now there are periods within this where we see exponential price to earnings expansion and lower earnings growth, and that's what you want to identify and figure out, which area do you want to play in. But to answer your question, momentum, does well not because of crowding alone. One of the reasons is crowding, but one of the reasons is that those businesses are actually doing really well. The underlying businesses are showing some earnings momentum. If you think about it, in terms of, let's translate what's happening on the underlying stock. So a stock is running up, say a stock is doubled in a year's time. Most likely there has been significant earnings growth on the underlying. Now that earnings growth could be a factor of great operational performance, by the promoter. It could be a factor of a commodity cycle that the industry is seeing. For example, we saw solar being a part of a momentum portfolio at some point of time, and that was because of two things: because of guys who were positioned well to take that upside, but also there was a cycle wherein solar businesses or renewable energy businesses were doing really well. So all of these factors get captured in momentum. Every cycle has a new reason for the returns.
So another factor that we need to look at in terms of why has momentum done so well, the factor is survivorship. So what ends up happening is, let's say if you just look at a Nifty, let's say if I compare Nifty to 30 years back, how many constituents were there in Nifty 30 years back that are still there today? Do you know what that number is, Prateek?
If I have to take a guess, I would say like at least 50% would be there in the index.
Correct. So over the last 30 years, 80% of Nifty has, churned over time. That means roughly 40 stocks have been removed from Nifty that were there, close to 30 years back. So Nifty also follows a particular pattern.
So that means today there are only 10 businesses that exist from 2000, say,
1995 to today, 10, 11 businesses. That's what exists.
Only
so
20%.
probably the Reliance and Unilevers
and HDFC and
and
some
those are the
other
only
banks,
businesses that have
SBI,
remained, and there are 40 businesses that
have churned.
have gone out of the index. So
That have
probably
gone out of the
like
index.
our loss-making businesses.
Correct. So I'll also tell you like how Nifty gets formed. Nifty, every 6 months there's an exercise of the companies with the largest free float market cap. Now what this free float market cap does in a way is that, let's say if there was a company which was ranked 53rd, now it has moved up the rank, which means it has gone up. Now it's a part of the index, and some company which did not move up or probably went down, now that has been removed from that. So when I say Nifty has done 12% over the last 20, 30 years, it's this portfolio that, has churned over time. The new stocks have gotten added. The older ones have gotten removed. That's the portfolio that has done about 12%. Now, can I make that portfolio slightly better? Can I make that portfolio more focused on performance rather than just the free float market cap? The answer to that is yes, and it has been tested all across the different markets all around the world, and we see that this tends to be a winner over a long period of time.
Right. So when we look at momentum, we also have to look at the downside, which is the kind of crash risk it has. Right. So what causes momentum to see these kind of sharp drawdowns in different periods? What's the idea there?
So we spoke about this earlier, wherein whenever you're trying to dissect momentum returns, you're seeing that whenever there's exponential return, it comes because of price to earnings expansion. And why does that price to earnings expansion happen? It happens because the markets move in cycles, and you're seeing significant euphoria in those businesses. So say let's take a case of 2024. So all of 2024 momentum did extremely well. By September, October, we had seen a peak in the momentum across all the momentum stocks, and at that peak valuation or that peak price, what you're looking at is people are euphoric. They are looking at that this earnings that the companies are showing is going to go on for the next 5-7 years. There is no risk taken into consideration. People are not talking about risk anymore. Everyone's just talking about multi-baggers. And not only momentum, across market, these are cycles that happen wherein there will be phases where people will forget about risk. They'll forget about what the future holds, whether this can happen or not happen. It's just about talking about multi-baggers and how it's really easy to make money in the markets, which momentum sort of captures the best way. So momentum will see, like at least the last leg of the bull market, momentum will see exponential returns. Now this causes the large drawdowns. So, extreme euphoria are also reasons for, extreme drawdowns. And this is a characteristic of momentum that you need to understand, because, this is going to happen again and again, and people will be in that phase, and this cycle will continue. So the large drawdowns are a, case of extreme risk taking by investors.
Correct. So as Rishabh said, that's absolutely right. In terms of the businesses that have gone up significantly, also tend to go down. But let's try and understand first why momentum fundamentally works. One reason is definitely like price movement, because the price has gone up. There are more investors now participating in that. But why did the price go up in the first place? We believe that the price of a stock will go up because there's earnings growth. Now, earnings growth ends up being a quarter delayed, or 6 months delayed, only after the results are out, people see it. But can you take a call on the earnings before the earnings have come out? The answer to that is yes. Let's say if you look at an FMCG company, there's if you go out in the market, you'll see that a particular product is selling more than what it was earlier. Maybe it's better brand name, maybe it's better positioning, maybe people have more money to spend, and then before the results are out, you can take an educated guess that this particular company might post better results. Now let's say if you talk about an oil and gas company, there are satellite images of what the storage level is for oils, and you can preempt what the end result of that earnings number is going to be. So what ends up happening is the prices of the companies which are going to post good results, those have already gone up, and you've taken a significant position in them. Now what happens is, since the price has gone up, a lot of new investors also end up participating in these, considering that the earnings might be spectacular. But then there are times in the market where maybe the market as a whole hasn't performed well, or maybe the earnings weren't up to the expectations, and then these are the businesses that end up falling more than usual. So if you do it systematically, let's say if you end up doing it for 5-10 years, the chances are that you will be on the right side of it. But let's say if you end up taking a short-term call, maybe 6 months, 12 months, or let's say even a couple of years, it's possible that you can end up being on the wrong side of it and end up losing money because you just played that short-term cycle. So that is what I think like people should keep in mind while playing the momentum game.
Right. So this particular downside of momentum, or let's say call it crash risk, can it be managed, or one has to accept the volatility of momentum?
Let's say our base understanding, let's try to develop that. Let's say if the market, when I say market, let's call it Nifty. If Nifty is up 10%, we expect momentum to be up 15 to 20%. Let's say when Nifty is down 10%, we expect momentum to fall 15-20%. Now there could be an investor who could be okay with the short term volatility within the momentum index, thinking that I'll only look at my portfolio 10 years down the line, and I just want higher returns at the end of the period. Not all investors want to play that game. They want to avoid short term volatility within their portfolio. There are different ways to manage that. Momentum could just be a sleeve in your entire portfolio, and you can bundle it up with other uncorrelated assets, which could be gold, or which could be other factors as well, including value. It could be low volatility. What this helps do is, maybe your return might not be 20 to 23% over the long term. It might reduce slightly below that, but your journey to get there improves. When the market falls, when the Nifty falls 10%, your portfolio will not fall 15-20%. So what will happen is, you'll still end up making more than what the Nifty does, with significantly less or slightly less volatility than what Nifty ends up seeing. So it's about how you manage the risk, about how you manage the other allocations within your portfolio, whether it's doing with a different factor, or whether you're doing it with a commodity. It's in the end deciding what works best for you.
Yeah, so what you're saying is that momentum gives really good returns with high volatility, and to manage that volatility, one can allocate to different assets in their portfolio. Otherwise, over a long term, the volatility, if someone can bear, then they can allocate to momentum.
Correct.
So my next question is, when we look at a momentum, right? Momentum funds have become popular in India. Is it a good strategy to allocate 100% to momentum for an investor, or that is a very subjective call?
See, this is a very subjective call. I mean, depends on investor to investor. There are guys who are willing to risk it all and take that long-term bet. There are guys who are saying that, I can't see that kind of volatility. So I think it's a very subjective thing. One thing that you want to sort of, if you want that exponential return, like if you want to make north of say 20-25% per annum, entry point matters a lot. If you're going to enter in phase of euphoria, don't think that you're going to get that return, because you're going to start in a negative cycle where you'll see that 25-30% drawdown very easily. Like September 24 to March of this year, we saw like a 25 to 30% drawdown in across all momentum ETFs. So if you're going to start at peak valuations, don't expect to make high double digit growth. If you want that high double digit growth, then you'll have to time the market. Sorry to say, but that is the reality. Or you'll have to have a staggered investment approach. The best way to approach this is just do an SIP. So you're not worried of timing. If this is not a full-time occupation, it becomes very hard to time the market. It just makes sense to then do an SIP, because at least you'll get an average return out there.
Should momentum be a part of your portfolio? The answer to that question is definitely yes. Now, how much of momentum should be a part of your portfolio depends on, as we like tell all of our investors, it depends on two things. One is the investor's risk appetite, and second thing is the market timing. Rishabh touched upon, the market timing where you can take advantage of it to increase your portfolio IRR. It's possible that you won't get, and very likely that you won't get 100% success rate, but anywhere 2 to 3 times, 2 out of 3 times if you get success rate, that is a winning strategy. Now coming back to the investor's risk appetite, if your risk appetite is higher, for example, it could also be a portion of your portfolio where your risk appetite is high. For example, out of 100, if you think 20 is something that I can invest in really high growth and I can end up seeing volatility in that, then that fund should be parked within momentum or a variant of momentum. But let's say someone has very low risk appetite, someone who only historically has invested in FDs or bonds or fixed income, for them maybe that will be a lower allocation along with some other uncorrelated asset which will reduce the volatility of the entire portfolio.
Got it. So if momentum works brilliantly on stocks, does it also work that well across different asset classes?
Absolutely. I mean, like we spoke earlier, the concept could work across different asset classes, different factors, not only price but also say earnings. So there are times when gold does extremely well. There are times when equities does well. There are times where you shift to debt also. We are not implementing something currently within Qode, but from our history, from our testing, we've realized that I can give you a simple example where when nothing is trending, or there is a time where there's a bear market going on, moving to cash makes sense. So that is also a sort of a relative momentum where moving to cash or moving to bonds is a prudent call, because equities are doing badly and models end up doing really well. We've seen lots of models, but we are not implementing anything as of now. So I guess outside of our zone today.
Right. So one loose way, as Rishabh mentioned, momentum is nothing but a trend. Now we have tested multiple trend indicators and we see it works across different asset classes, including equities, including commodities, including a bunch of other things. So trend as a factor works. Now if I just look at equities, within equities itself, it's there's relative momentum. For example, out of say 500 stocks, I'm choosing 50 which have done the best. Now that same analogy I might not have with a gold, or let's say with 10 commodities within themselves, saying this one has done better than the other, because the universe is not that big, but we can confirm that trend as a factor works.
Right. So we touched upon like having momentum and having other part also in your portfolio to make it even more robust and make it less volatile. So what other factors would you combine with momentum, and how should someone go about creating a multi-factor portfolio? What are your thoughts on that?
So I can take this one. When you're combining, first thing is that you need to understand what the objective of your portfolio is. For example, when we are building something like all weather, the objective of our portfolio is not to maximize return. The objective is to have a good Sharpe ratio, a good sort. Our risk metrics need to be in check. For us, that's of key importance when we are looking at a portfolio. Now, the way we look at it is, if you have a momentum portfolio, I want to have multiple uncorrelated assets. So stuff like gold, low vol, value as a factor, and then figuring out when to allocate where. That I feel can have you can generate significant alpha. You don't need to be 100% invested in momentum, but take a step back, try and understand what kind of businesses are there within the momentum portfolio. Just don't work on the factor and run a backtest and figure out what the output is. Figure out what kind of businesses are showing up, when do they do well, figure out what kind of businesses show up in a value factor, in a low vol factor. When does gold do well in a high inflation environment, in a currency depreciation environment, and then you can model a portfolio and come up with an optimal portfolio. If the objective is keeping risk in check, if that's not the objective, running a momentum portfolio could do well, but again, timing becomes an important factor out there.
Perfect. So if you want someone who's watching to leave with some thought about momentum, like this is the one key insight, what would that be?
One key insight is track the underlying earnings, and then invest in the momentum portfolio. When you're seeing that earnings is growing at 10% and the portfolio is up 30%, that's a questioning call. It's very easy to be a part of the bull cycle, but because momentum does very well during those bull phases, but most people are not able to take that call when it does not make sense to invest in momentum. So with momentum, it's important to take care of the risk rather than taking care of the return. So if you're investing in momentum, figure out that you enter at the right times.
Otherwise, the cost is very high. We've seen like every 2 years it sees more than 20% drawdown.
Absolutely.
So that can be very much
So
something
key
that
part
you can
is
see.
with momentum is take care of the risk. The upside will take care of itself.
Perfect. Great.
Perfect.
So let's move on to the next section.
Yeah.
Okay, guys. So it's time for our next segment, which is scroll check. So let me just read out the post. It says, momentum is literally buying stocks that already went up, hoping they would go up more. That is not investing, that's just speculation. Graham and Buffett would be appalled. I will stick with the fundamental analysis. Momentum is for traders, not investors. Factor investing is quantitative gambling.
Absolutely. If you think that you're just going to look at a factor and then you're going to invest, it's you're spot on. It's gambling, it's speculation. If you figure out what the factor is doing to the underlying portfolio, what kind of business you're picking, then you're leaning towards the investment side. Then you take a deeper dive into what kind of business are there. Fundamentally, are they sound? And are you actually paying for the growth or are you paying for euphoria? If you can differentiate between that, then you have an answer for yourself out there. So you can't just rely on the single factor and then decide that I'm going to invest on this.
Yeah, I think the key here is to look at it from a portfolio approach rather than picking one particular period. The idea is you are trying to test a factor over hundreds of years of data. The idea is that you're not just picking stocks that have run up and then done nothing after that. What we have seen is that after the stocks have run up, we have seen positive earnings growth. 75% of price and growth has been explained by earnings growth. So it's not randomly going up. It is actually preempting the growth that the companies are going to show in the future. So that as a factor works. Obviously, you can't pick a 2-year period and say that, hey, it did not work for this particular period. But if you look at a longer period, if you end up looking at rolling returns for a longer period, you'll end up seeing that this works more often than it does not.
Right. And you need to take care of valuations. Valuations become an extremely important part of play. Just don't look at a momentum portfolio and say I'll always be invested and I'll enter at crazy valuations. You're never going to make money doing that. We've seen that in the last 1.5 years where most investors have burned their hands doing that. You want to, price plays a very important part. You have to enter at favorable valuations and you need to track the portfolio valuations when you're entering.
Yeah, so basically the way we do quant is also backed by fundamentals. So when we look at valuation and we're seeing it's backed by fundamental earnings, then the factor is not speculation. Right. So next question is, so the next post is, everyone chasing Nifty 200 momentum 30 is playing it safe. Real alpha is in small cap momentum. I run a screener picking top momentum small caps monthly, 60% CAGR in 2023 to 2024. Large cap momentum is diluted. The edge is in small and illiquid names that institutions can't access.
So I think it depends on objective to objective or person to person, where now if someone is, first thing, don't look at one period of 1 year where you're seeing 23 to 24. That same 60%, if you look at 24 to 26, would have been negative 35. So just picking up one period and then saying you're going to make 60% is absolutely does not make any sense. Look at longer term periods. Obviously there is a risk premium because of which you're going to do much better. So across backtests, across different factors, including momentum, we have seen this, that the small caps and the micro caps end up doing a lot better than the large and the mid caps, but they come with their increased volatility. So if a large cap momentum portfolio will see a 20% drawdown, a micro cap and a small cap portfolio will see a 35-40% drawdown. The beta is a lot higher. So if you're only chasing returns, yeah, obviously the small cap space will see better numbers. If you are you looking at risk adjusted returns, are you looking at where the alpha is relative to the benchmark? That's a proper way of looking at it, right? So if you're looking at a large cap momentum portfolio where you're looking at only the top 100 businesses, look at how it has done relative to the Nifty rather than looking at how it's done relative to a small cap index.
Right.
But one point I think the post mentioned is absolutely right. There are enough options available to invest in mid cap momentum, which could be a 150-50 momentum index. There's a 550 momentum. There's a 230 momentum, as they mentioned. There isn't a readily available momentum ETF or index available on the small cap space. In fact, that's a gap that we also identified. And if you look at our Qode growth fund portfolio, what we've tried to do is make our version of multi-factor model, which includes momentum, and pick 30 stocks that get churned over a period of time. And we also see that we end up getting a much higher return, close to 29-30% return year on year over the last 15-year period. Though the drawdowns continue to remain high, but someone who's looking for a higher aggressive allocation within their portfolio, this is something that we are suggesting to almost each of the clients. So I think there is some merit saying that there's no product available in the small cap space, and that is something that can be used by quant firms like us and investors who understand this gap.
Right, perfect. So time for our next section, where we are going to go for answering the internet. So we've received some questions in our DMs and I'll be just reading them out to you. So the first one is, if everyone knows about momentum biases, now shouldn't the edge disappear?
So I think the edge will remain. The edge will remain not, if you're entering again at peaks, the edge will remain if you're able to time the markets well. The great thing about momentum is that you get a lot of opportunities if you're willing to be patient. So you'll see those cycles in momentum, and you'll see that more explicitly in momentum as a factor as compared to any other factor. With value and low vol, you don't see those cycles because you don't see those times of boom and bust. In momentum, you see those times of boom and bust, like 2008, you would have been down like 80% on the portfolio from its peak value. Then 2009 you would have been up 120%. So you'll see those cycles. If you're able to be a part of the cycle on the right side, for which you need to be a rational minded individual, a rational minded investor, you need to be logical, then there is enough edge. I don't think the edge will go away.
Okay. Next one is, can I build my own momentum strategy using a stock screener?
Absolutely. We've seen different versions of momentum succeed. I'll just give you some examples that we've tested. For example, the momentum index that's available ends up churning every 6 months. Now, can you generate slightly higher return if you churn it every quarter? The answer to that is yes. Can you look at one particular segment? Let's say the mid cap 150 momentum 50 is just looking at the mid cap space. Can you build something on the small cap? The answer to that is yes. Can you build something on the micro cap space? The answer to that is also yes. Can I combine momentum with another factor and build a multi-factor model? The answer to that is also yes. The broader question here is, can systematic investment in momentum help me generate alpha? And we believe the answer to that is largely yes. You have to obviously look at some pitfalls that could exist. For example, if you churn too frequently, then you won't end up getting the same price every time. There could be higher impact cost. Can you trade every month instead of every quarter? We have seen that the results don't improve, but the impact cost brings the return down if you end up doing that. So how you build the model is important, but different models can definitely be built.
Thank you guys. We went into a lot of detail about momentum, and I'm sure viewers got a lot of insights out of it. So thank you so much, and it was a really good conversation.
Thanks, Prateek.
Thanks, Prateek.
Weeks ago, momentum was a no-brainer. Today, the fund that represented it in India is ranked 87 out of 90. And yet nothing about momentum as a factor has actually changed. The paper still works, the 150-year evidence still holds. What changed is the gap between what retail investors thought momentum was and a one-way street, what market research has always said it is. High premium factor that crashes hard at regime transitions. The edge is not identifying the trend, the edge is surviving the reversals. So subscribe and remember, discipline compounds, momentum is just one of the tools.